Hey, Steve.
Hey, Brett Starr. How you doing, buddy?
I'm doing great. I'm Brett Starr. I'm the CEO and founder of the Starr Conspiracy. He is Steve Smith, our Chief Marketing Officer and partner of the Starr Conspiracy. We've known each other for way too long. And we are here to talk about work tech. Work tech. This is Work Tech Weekly. Following your amazing newsletter that you put out every week. Newsletter last week was about full-on meltdown of the tech industry.
Well, I don't know if it's full-on meltdown, but I mean, we're definitely in a transitional period.
I'm being dramatic. It's a subscriber drive.
Oh my God, the sky's falling.
Smash that subscribe button.
That better? Okay.
Yeah. Well, you did say in the newsletter that this was the most significant downturn in the tech sector since the internet bubble of 2000, 2001?
Yes.
Ish. I was there. I was living that. Living in Austin, Texas.
I was not living in Austin, Texas. I was in Dallas.
Ooh. Crazy times.
So yeah, the graybeards are speaking. How exciting for everybody.
Yeah. Well, you know, it was funny.
What?
People won't believe this, but back in the .com bubble, a lot of folks felt that the internet wasn't going to work out.
Yeah, this whole internet thing.
Yeah. I was like, what? Who's the columnist for the New York Times? The economist, like Paul Krugman, is that his name?
Yeah.
Paul Krugman had made the pronouncement in the 90s that the internet was going to have about the same impact on society as the fax machine had. And then he wrote after the bubble burst that like a "See, I told you so" piece about how the internet was not significant.
Well, you've heard that joke about economists, right?
No.
Economists exist to make the weatherman look good.
That sounds about right. Well, I asked you before we jumped on, do you want to talk about, all these layoffs and, what's going on in the tech sector? And I think you were kind of like, no, fuck that. Let's talk about the opportunities. And I think that's a great idea. I will say, by the way, in my opinion, work tech is already through the worst of it. I think work tech moves a little bit in front of other tech sectors because it's so closely tied to the employee experience. That it's been my experience in the past that when there are downturns, it hits work tech a little bit sooner and we exit a little bit sooner.
Well, and generally speaking, I agree with that. I think that what remains to be seen is, when you have these sort of mega brand layoffs like we're seeing with, Microsoft and Salesforce and Meta and Amazon, just and Alphabet now, what is the trailing effect of that? Because I think that, when you look at just the layoffs in January in the tech sector broadly, we're already at like, 1/3 the total number from 2022. And there were a whole slew of layoffs in work tech specifically, about just the ones we can see so far this month, it's been about 15 or 20. Yeah. And so big ones. And so I think that the real question is, it's clear that the tech sector overhired coming out of the pandemic and even before the pandemic. Has all of that unwound yet? And what is the effect of inflation going to be on this? But what I'm actually a lot more interested in now is, because I believe, whether or not we're going to see, the worst of it behind us already or not, it's going to happen for work tech sooner than everybody else, as you said. But what I don't think everyone has quite wrapped their minds around yet is the fact that look at what's going on with Salesforce, with Elliott coming in, and they've got serious pressure from an activist investor, and I think that is symbolic of the sea change in how SaaS companies are going to need to operate in this post 22 environment. And it's just like you have an entire generation of marketers who have come of age since 2008, when essentially we were in this market with zero interest rates where money was cheap. So it was easy just to like take down a bunch of money, let's growth hack, throw money at the problem, basically just scale up and get big.
Yeah.
And I think that we're entering a period where it's just like that there's going to be, investors are going to expect growth, but also responsible growth and profitability.
Yeah. Let's also, take a moment to think about the impact of the payroll protection program on this phenomena, because a lot of people don't talk about this. It's not a popular topic.
Yeah.
We at the Star Conspiracy were beneficiaries of the PPP. It was incredibly helpful for us at a time when, a lot of businesses, true small businesses, were 60, 70 employees, true small businesses, really needed it. Increasingly, and we were blowing the whistle when this was happening, but a lot of people who, took those loans didn't need them. They were, portfolio companies in venture capital funds. They were, like Tom Brady, they were like, and so if you have low interest rates, basically free money to finance growth. And on top of that, you have an infusion of, some number of trillion, dollars, into business that's not all going where it's supposed to go, but it all is legal. It's just, ethical and legal are two different things. There was a lot of money floating around at the end of this cycle that probably accelerated and deepened our descent into where we are now.
Yeah, I totally agree with that. But I think what's, interesting is just how this is going to change the operating dynamics for, SaaS companies generally and work tech companies specifically. I think that, part of the good news coming out of all of this for work tech is when you look at the number of work tech companies that are they're sitting on the sidelines with really great fundamentals waiting to IPO. So like there was a article a couple of days ago about Deal, it's just like they went from, I think less than $20 million in ARR in 2020 to now they're like at 265 and their margins are like 65%. So, they're blowing apart rule of 40 metrics. And then you got like, all of these companies within sort of HCM, the HCM space, whether it's sort of like new school or old school, you got the Daily Pays and the Papaya Globals and folks like that, I think that there is a whole slew of great companies that are primarily HCM based, not all of them, but there's probably 2 or 3 dozen work tech companies that could IPO once market conditions get better. And I think that when that happens and the market looks and says, hey, look at the fundamentals of this company, that's a real company and it's growing crazy. Let's start throwing some money at that, combined with the effects of generative AI and how that is going to change workplace technology. I feel like, whether or not we're some part or most of the way through, this current downturn, all of the fundamentals for and the ingredients for a fantastic work tech market through the end of the decade are there.
Well, and this will be helpful for that, right? I mean, you look at one of the companies on your list was Lattice. Lattice did what they refer to as a reorganization and reduction in force. So, I don't want to be a close reader, but those are two different things, right? A reorganization and a reduction in force, 15% on 700 employees. So about a 700 employee organization. That's an organization that, if I remember correctly, has taken on something like $300 million of funding or something like that.
Yeah, something like that.
I mean, it's an incredible amount. I could pull it up here, but let's just say it's, bigger than a bread box. Isn't it likely or possible that a 700 employee company that, has taken on $300 million of funding and, based on their employee size is, in the 9 figures of revenue, right?
Yeah.
That reducing payroll by 15% and reorganizing is a prelude to preparation for an IPO.
I think that's part of it. I mean, some of it is just every company everywhere is, modulating their burn rates to not have to necessarily raise money for the next 2 years.
Yeah.
And, I don't know anything about Lattice's fundamentals. I think that they are, they seem to have almost a lock on sort of the category leadership in this continuous performance management category, which would probably put them in a position for an IPO. But there's sort of one of two things going on. Either it's just like, let's clean up the balance sheet so we look good, when we have to file an S1, or it's, hey, we can't raise money again until 25. So let's right size our organization to make sure that we can make the money last.
Yeah, it's probably one or the other. But, the reason I bring it up is because there's a lot of good that comes out of moments like this. Mm-hmm. And the pressure that is required to operate a business, whether it's, hey, we've got to, conserve cash for 2 years because it's a bad fundraising environment, mm-hmm. or whether it's we're getting ready for an IPO and need to, show some, hint of our ability to get mm-hmm. to profit. Mm-hmm. Both of those can still be seen as a reaction to the downturn that we're in. And the reason I bring Lattice up specifically is because I don't want an overcorrection. So you mentioned like, hey, maybe the way that people look at SaaS companies is going to be different, forever, right? And I don't want that to be the case, because Lattice grew 200% in the last 2 years, 200% in the last 2 years. They did that by not being, forced to think about that pesky profit equation.
Yeah.
Right. And so a lot of value. And so go back to, the gray hair is talking now, go back to the Success Factor Taleo days, right? Right before their IPO, Taleo battened down the hatches and tried to get profitable.
Yeah.
Success Factors let it all, like fly, just still trying to get, market share.
Yeah.
And both of them had about the same IPO. Mm-hmm. I think that Success Factors got there a little bit faster because I think they were founded in like 2001 and Taleo was like 1999.
Yeah.
But they ended up in about the same place. And I would argue that Success Factors under SAP is doing much better than Taleo under Oracle.
Yeah.
But that whole, run up of a company that was able to lose significant amounts of money, invest in growing market share, had an irreplaceable impact, not just on WorkTech, but also software as a service.
Yeah.
Right. It was, if that IPO doesn't happen, if that class of SaaS companies, don't have the trajectories that they had, Salesforce.com, mm-hmm. SuccessFactors, et cetera, where they had a significant, period of like fast growth, no profit, then this whole category doesn't exist the way it exists now. And the innovation doesn't, show up.
Yeah. And I think that's, what you're kind of like, poking around at is a really important question, because, there's a lot of factors at play. So number one, what is no doubt going on now that is similar to that early stage of the market is you look at SAP, basically lit the fuse by acquiring Success Factors because their efforts into the cloud had completely fallen flat, and they bought Success Factors basically to give them a jump start into the cloud. Similarly, it's just like what you're seeing now happen is, like, if you look at Microsoft, they have over the past, 5, 6, 7 years, put a big bet on AI. A lot of their internal initiatives haven't kind of played out. And so now it's just like this money that they had been putting into OpenAI they'd put $1 billion in a couple of years ago. Now, I mean, I guess a story came out the other day that they've actually, made another investment. It's unclear how much. It's expected to be in the 10 billion range. It's the same sort of thing. And I think that there's a lot of big companies out there that are still sitting on a lot of cash that I think are going to have to buy their way out of some problems.
Yep.
If you look at the Workdays and UKGs, it's just like what's sort of, great companies, but what's sort of not said is like their core talent functions kind of suck.
Yeah.
And so it wouldn't be surprising if you saw a Workday or UKG decide, you know what, Lattice, you've got, everything looks good. We're just going to, here's 700 million or $1 billion or $2 billion and we're gone.
Yeah. But, and yes, but. For organizations to get in a position where they can benefit from purchasing a company to catch up with where the demand is in technology requires that demand is created. And there's a reason why this phrase of, demand creation was created, because no one goes out to buy technology, new ways of innovation. They are sold new technology and new ways of innovation, and selling new waves of innovation costs a lot of money. And everywhere you poke around and see dramatic improvements in technology coming out of the United States, right? There is always a market maker. There is always an organization that consumed ungodly amounts of money and lost so much money, but ended up creating the demand for a new wave of technology that other, consumers benefit from and organizations benefit from, like SAP when they buy SuccessFactors, like a UKG if they bought a Lattice, right? Because the demand finally catches up. The real demand finally catches up with the demand that was being generated through all those investments. So I think that as we are looking at this downturn, and, SuccessFactors got their bell rung when they were making their IPO, and people came out and they screamed about how could this company looks awful on paper. They're losing so much money. Yeah, got it. And there's going to be similar situations now where it's like, finally the insanity's over. Yes, the insanity went too far, right? It went too far. But if we overcorrect to the point where we're no longer able to or willing to lose money in order to create demand for new innovative technologies, then we're going to be in a lot of trouble, in my opinion.
Well, yeah. And I think that I suspect that what we're going to see transpire in the next year or two is an overcorrection in favor of, hey, we're looking at all of these, different HCM based or payroll based companies that have, look really good on paper. They're IPOing, they're getting acquired by larger players. I think that's going to draw a lot of investor interest back to this market. At the same time, you're going to have generative AI kind of going in parallel path, that there's clearly market demand, but it's not clear that there is money-making potential there. And I think that's probably what's going to kind of break the ice in terms of investing in innovation. Plus, it's just like when you look at the kind of the talent equation, there's been just widespread layoffs in tech, but tech had hoarded a lot of talent, and now that talent is going into other sectors. Yeah. But even with that, there's still, I don't remember what the equation was, like, how many million job openings versus workers just in the US. And I mean, that's true globally as well. Yeah. I mean, talent is going to continue to be a challenge, both, finding it, keeping it, engaging it, maximizing productivity, all of it.
Yeah. Totally agree. So if everything that you're, talking about, it ends up happening, if there's, IPOs that, kind of break the ice and, get the market moving forward, et cetera. I would just offer this opportunistic advice in that scenario, which is beneficial really in any scenario, is that when the IPOs happen and that starts to crystallize demand in those categories, because that's always what happens, right? There's an IPO and people are like, oh shit, that category must be for real. And that's when the mainstream buyers start coming in, right?
Right.
And so when that happens, that kicks off, it's been a long time since we've seen a wave of IPOs in work tech.
Mm-hmm.
So this is one of those areas where our experience, I'll just call it experience, is beneficial. Our age, our tenure, is that when IPOs happen, they tend to kick off a chain reaction of acquisitions.
Yeah.
Market demand for individual purchases goes up. Buyers, are buying. This is also, we've said over and over, going to be one of the biggest periods of solution switching in history. Mm-hmm. So that's going to be going on. Few IPOs crystallizes demand in a market. People are going to be buying like crazy. And each one of those IPOs kicks off on average about 7 acquisitions for every IPO.
Mm-hmm.
So those acquiring organizations don't buy companies they haven't heard of. Those new motivated buyers don't buy brands they've never heard of. And so there's a limited window here where, in an effort to, drive profitability, to tighten belts, et cetera, a lot of the major players in the market are going to pull back on marketing investment, and that's going to open the field for folks to make their name known, to make their brands known, their companies known, so that when demand picks back up, that brand recognition will translate into more market share than they would have had against a stable field.
Right. Well, and I think that you're touching on an even more important point right now is, there are companies that clearly understand that this is a time to invest in marketing, invest in brand building, knowing that you can do it on the cheap. But on the other end of the spectrum, there's also you're starting to see this come up a lot more, companies that have slashed their marketing budget and now are getting into basically performance marketing mode. Yeah. And so they're bringing in marketers from outside of the space, trying to apply essentially B2C performance marketing techniques that I think are going to lead to all manner of terrible outcomes.
Terrible
outcomes.
You and I were just on a CX session prior to this podcast. And that's where, we took a couple hours to explain holistic customer experience, how customer experience applies to times like these, but just generally speaking as, the way to get beyond this blocking and tackling world where the next model or the next whatever, is going to, be the competitive edge, because it's not. It's, we're done with that. The notion that you're going to implement a performance marketing, model, or the notion that you're going to implement a product-led, organization, or account-based marketing or something like that, and that blocking and tackling decision, that model decision, is going to be the thing that separates you from the pack. That doesn't happen anymore. Just doesn't. It's not there anymore because everyone's got the blocking and tackling.
Right.
It's really about, can you create a holistic customer experience in brand, marketing, sales, product, and customer success? And in times like these, you will go through periods where nobody wants to buy anything.
Right.
And, well, what do you do with your sales function when nobody wants to buy anything? What do you do with, all these other functions when nobody wants to buy anything? Well, the answer is focus on the customer experience, stupid. Because, don't mortgage your ability to sell to someone in the future by getting lost in your own, motion-based metrics, and trying to drive a sales outcome now because you got a number on a spreadsheet you need to hit. People need to know what customer experience they're forwarding in for their organization in all the subdomains of CX. And specifically in this case, and you've, mentioned this several times, a lot of revenue from companies this year especially is going to come from their existing customers.
Right. Yeah. Yeah. Growth in 2023 is going to come from increasing share of wallet with your existing customers, just because there's not going to be enough net new logos to hit the kind of growth that these fast growth companies are ideally looking for.
Yeah. I mean, I disagree with that, but I'm notoriously optimistic. I think that what we're going to see is in the second quarter, there's going to be a big bump, and it's going to be a combination of pent-up demand, so delayed decisions from 2022 spilling over into the second quarter of 2023, layered on top all of the new buyers that were already coming into market in 2023. I think we have to get through the first quarter, but I think we're going to see a bounce in the second quarter, and things are going to smooth out for the second half. That is my outlook. Write it down, mark the tape. But to your point, a lot of growth for organizations is going to come from expanding share of wallet within their existing customers. You have to approach that in an intentional way without ruining your CX. But that should also relieve some pressure from the sales requirement, and which right now I'm seeing this left and right. I'm seeing people destroying their customer experience right now. And, some people can afford to destroy their customer experience or their, experience, like Disney can afford to screw up every now and then. They can, come out and tell all of their employees that they need to be back in the office, and they'll bounce back. They'll do just fine because they have decades of history forwarding an experience vision of creating happiness for employees, customers, and shareholders. Shareholders will see any, dip in Disney's performance as a buy opportunity because they've got all this, track record and credibility. If you don't have that, if you're a startup, if you're into the third year of your business or whatever, and you don't have broad-based brand recognition, functional association, and brand attribute uptake of your company, and you turn the screws on sales and go to a turn and burn, call everyone 15 times and try to get them into that, new car, that can be something you can't bounce back from, depending on what your level of credibility, equity, brand equity is in the market.
And I think that is the point I was getting to originally, is just like we have a generation of marketers who came up in this connect, convert sort of environment where it's just sort of like, I want demo ready leads, fill that up. I want to flip them over to the sales team, and I want to we want to post a sale. And it's just like, that's not the environment that we're in right now. And I think that you're going to see a lot of marketers really struggle because they're still trying to, they're looking for buyers with intent. They're trying to, get the demo, get the deal done. And that, if what's really, and this is something you and I've talked about a lot, they're missing that engage motion.
Yeah.
And I think that we're in a period of basically prospect engagement is going to be key. And I don't think that's clicking with everybody just yet.
No. And I think it goes to what you're talking about, which is not enough people have been through this before.
Right.
There's two really important things happening right now. There is a tectonic shift in technology. It's like as big as the SaaS shift, going from on-premise to SaaS back at the turn of the century. And, we had a podcast with Dr. Patty Fletcher, and she reminded me of the tectonic shift before that, which was going from manual to on-premise, going from paper-based systems to on-premise, digital systems. And that was a big tectonic shift.
Right.
Well, we're in another, new organizing principle tectonic shift. That's a big deal by itself. For some reason, these big shifts always, happen at the same time as a big turn down, a downturn. And I don't know why that is. I don't know if it's just like, confirmation bias of looking back at the, the last big ones. But when you've got a downturn happening at the same time that you have the very fabric of technology changing, right? Driven by the pandemic, driven by new models of work, driven by AI, driven by all these innovations, the metaverse, which is not fashionable to talk about for these, last few months, but will be again someday. People who have not been through that do not realize that market maturity, economic context, and field dynamics have an impact on what you should be doing in marketing. You can't just run the same playbook over and over and over again.
Right.
And so this is a moment where you have to carefully explain things to people for a long time.
Right.
You have to, engage prospects in conversations about the economy, in conversations about changes in technology, and in conversations about the paradigm shift that's going on and how you fit in to that, zeitgeist.
Right.
And there is, in times like these, boy, I'm sounding like a real old guy. I feel like the theme of this one's old guy.
I know, this cranky old men. Yeah,
it's cranky because, the relative, God, I'm gonna get nailed for this. The relative importance of different generations of workers becomes significant at different times in market development. And when you're in a blocking and tackling, scoop up the demand world, it's the, young run and gunner, digital marketers who, can, lay out an infographic of all the systems that you need, create the data lakes, get all the intent, signal marketing in and all that stuff. And that becomes the premium marketing position. It becomes very performance oriented, becomes very, systems oriented, et cetera. Right. When you enter into an ambiguous period like this, they start wheeling out all the old people again. Yeah. And brand becomes more significant. And conversation and engagement becomes, more significant. And, I think this is that moment where a lot of the folks who have made their career over the last 10 years being hardcore, basically direct marketers, yeah, right, get that bit of experience that shows them that their models are great models, but they're relative to multiple contexts that happen in cycles. And this is that next step forward, in their understanding.
Well, yeah, I mean, you go back to, 2001, kind of the dot-com bust. It's just like that really was the event that ended up setting SaaS on its course for, the first decade of 2000s. The 2008 bust that went through, 9 and 10, it's just like that basically, that was the cash out for, SaaS companies. So that's where you saw, the SuccessFactors, Taleo, Connexa cash outs. And then also, but it set the course for these mobile and, kind of social, UX and the changes that brought. Yep. The companies that then capitalize on that became really, it's just like we're going to see a lot of those companies begin to cash out, but then AI becoming coming along at the same time we're experiencing this downturn. And so yep. You're right. It's just like those periods, they coincide, new technology plus, economic, ambiguity. But one more point I want to make on, customer experience and just like, that whole idea of those kind of the performance marketers that, when the market's established, what you need to do. It's just like you're applying all those formulas. But, going back and looking at SuccessFactors and how they came about was Lars Dalgaard bought the wreckage of like a dozen companies from the dot-com bust, put them together, basically created SuccessFactors. But a lot of their growth, there's one fact that I think is really interesting. It wasn't through performance marketing and digital marketing, although they were great at that. A lot of their growth happened because there was 1 year where Lars Dalgaard was basically notched more miles on American Airlines and more miles on United Airlines than anybody else in the world. He was on a plane literally every day, going to sales meetings, just hustling and selling shit. And it's just like, I don't think you could do that today the same way you could at that period of time, just because of a lot of things. But it's that idea of you have to get out there and hustle if you're a founder, and you have to think about the experience that you're creating with that customer, whether it's I'm going to plop my ass in a chair and we're going to whiteboard a bunch of shit for 3 hours in your conference room, or how are you going to engage with that customer?
Yeah, no, I totally agree. I think you're onto something huge, which is, there is a time for a visionary leader and close-in work, and there's a time for an operations-oriented leader and process orientation and effectiveness, right? Mm-hmm. When you are in a moment of, like, if you are in work tech right now and you are not tuned into the fact that this is the biggest opportunity that we've seen in this market for a decade, like if you don't see that, you're in the wrong business, because it's almost like the planets aligning, because it's more significant than the great financial crisis. it does go back, to the bubble, the original bubble, and SaaS and the conversion from on-premise. It's that big, with even additional layers on top of it. And it is time for close-in work. Like if you're in an established market where there are lots of buyers buying the same shit over and over and over again, and the need for vision casting is low because people are buying in defined categories, then you can get an minded leader and executive management team, and you can press out widgets, and you can focus on process orientation and performance marketing and all that stuff, and just create the most, profitable business that you possibly can, with recurring revenue, repeatable processes, and referenceable clients. The 3 R's. There you go. Right? In times like these, that shit doesn't work. Blocking and tackling isn't enough. You need a visionary leader. You need long conversations. You need close-in work, right? You've got to get in there and not push people through a buyer's journey or a funnel or whatever. You have to have a holistic approach to customer experience, and you have to focus on engagement. And Lars is a perfect example of somebody who was doing the right thing at the right time. But what you really saw was that being extended in to the sales process and to the marketing process because of the zeitgeist.
Right.
And so the zeitgeist has changed. The spirit of the times. So people throw around zeitgeist, and often I think people are like, oh yeah, zeitgeist. It's the spirit of the times, right? The spirit of the times has changed. And it requires more leadership at every level, and less blocking and tackling and process orientation, and more problem solving and critical thinking.
Right.
And if you do that, and if you can let go of, some of the burdens of over processing and over management and over, et cetera, then this will be the biggest opportunity that, most of us. I think this is going to be the last and biggest opportunity that I see. I think it's going to be another 20 or 30 years before we see anything like this. And I won't be around for it. I won't be running a business.
You never know. We might just have your head floating in a jar attached to a robot, and, you can dispense all this wisdom again in, 2055.
Well, did you see the article about the scientists who were able to reverse aging in rats?
No, I didn't.
Oh yeah, so they've done it. There's all these people focused on longevity, and they've actually figured out how to reverse aging, and not just stop it, like reverse it. Like they take an old ass gnarly rat, and they can turn back the clock to like a rat in its 20s. They take a 60-year-old rat and they can take it back to a 20-year-old rat. Every cellular structure, vision, hearing. The gray whiskers go away, it becomes, and Jennifer sent me the article, and she's like, well, there's still hope for you. And I'm like, I'm going to pass. There's dignity in aging.
Yeah.
All right. I'm Brett Starr. He's Steve Smith. Thank you for joining us today in this conversation about nothing. We're like the Seinfeld of work tech podcasting. It's the show about nothing.
Just without the pirate shirts.
Please tell your friends. Please subscribe. That's my New Year's resolution, to ask people to subscribe. And my son taught that to me because he's always watching YouTube videos. He'd ask people to subscribe. Say, smash that subscribe button, Daddy. Smash that subscribe button, Daddy. All right. Take care, Steve.
Thanks, Brett. Bye.
Teach you everything I know.